What's up? I'm Dan Fredenberg, and this is another chance encounter. Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building. I'm joined with Amit, and is it Garg? Is that how you pronounce your last name?
That's right.
Yeah. All right. Phonics for the win. And how you doing today, Amit?
I'm doing great. It's sunny day out and cannot complain.
Absolutely. And I got even more good news for you, mate. You may not know this, but today we are joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, investors, buyers, sellers, all that kind of stuff. And you might be thinking, why would anybody want to do that? And the answer is if you've ever heard of private off market deals that you're not allowed to publicly discuss. They're sometimes called 506B deals. Well, the SEC attorney in your network should have told you you need documentation of your substantive relations, or else the SEC will get ants in its pants and take away your business, and that's bad. So that's part of what we're doing, but the benefit for you for watching is you'll be able to more effectively communicate on the subject of commercial real estate deals, and you'll understand how my guest fits into them. But before we get too excited about real estate, do you want to introduce yourself a little bit?
Yeah, absolutely. Uh, Based out of Seattle, I'm a tech guy. I have been in IT industry from last 12 years, working with a famous brand, Lululemon. I'm sure you have heard about it.
Mhm.
So yeah, that's what I do. Build cool things in their app, so that it make it easier for people to shop. Uh, but from last 1 year, I have been fully deep dived into commercial real estate. I have been investing in commercial multifamily from
Mhm.
last 1 year, and I have a team in place where we are investing in the Phoenix market.
Mhm.
So that's something which I'm doing nowadays, and I'm spending a lot of time on this and educating and learning a lot.
Excellent, excellent. I love it. So I forgot to go to the first slide, and it says, "But wait, check your eight." So you're a technically inclined guy. Tell me if you can do this. Can you please look through the camera and into the audience's device? There might be this big, hideous subscribe button, and like it's free to get rid of the ugly. You just okay, it's a stupid joke, but whatever. I like making it anyway. So let's get back to business. The five distinct motivations. At this point, I've now interviewed over 350 different people in the commercial real estate investment space. So we're talking about deal sponsors, operators, repositioners, the whole gamut. And everybody has their own unique reason why they came to commercial real estate, but we need to know what that is when you're in this industry. And the reason for that is because there's plenty of risks involved. The deals take years to go full cycle and they take months to close. So you need to get a feel for why this person isn't going to throw in the towel. And even though there are these, infinite number, well, I suppose it is finite. There's a finite number of reasons why somebody would pursue commercial real estate, but I've found they fit pretty neatly into these five. The first one of which is preservation of purchasing power. What on earth is that? Well, some people don't have to hold a day job. They don't need a W-2. So the way that they make ends meet is because they already have a portfolio of assets, and the proceeds of ownership, in other words, profits, are how they get their income. Now, if you're already set up in that situation, you might ask yourself, well, why would you go through the hassle of doing a deal that takes months to close and has all these different risks involved? and headaches, you might say like, well, why would you bother making another acquisition in the first place? And the two biggest reasons that come to mind, the first one is inflation. Whenever it rears its ugly head, it's going to take away from the purchasing power of your cash flow. So that means it's going to be time to make another acquisition. The other time is when there's distress or an asset crash. Basically, everybody should be trying to get the steepest discount on purchase that they possibly can. But if you are more in a preservation of purchasing power position, you are exclusively going to do deals when they're at a steep discount. So I have to fully disclose, I'm not this far in my career yet. What describes my motivation most accurately is trading time directly for wealth. And that's because I also have a tech background. Me specifically, it was in the CRM agency space. And after doing that for multiple different types of business sectors all at the same time, with doing API integrations, all that kind of fun stuff from hand, I eventually got hired for a real estate firm, a guy who was flipping 10 houses a month or doing 10 house transactions a month since before he hired me. And we were doing millions a year in revenue and sending 5 to 7 million emails a month. So it's like nothing compared to what Lululemon's doing. But at the end of the day, I found out that chasing a bigger and better salary came with a gigantic tax bill. And here's my boss making way more money than I am, and he's getting to keep more of it because he's doing tax advantaged activities. So it hit me, I need to pivot and figure out a way to get rewarded more in the deployed capital side, in other words, equity, and less in salary. So that's what I'm doing, and I get that that's a little bit abstract for some people. I'm sure Amit can read that loud and clear with his background. But a lot of other youngsters, they are more interested in hustling like crazy right now so they don't have to later. Maybe it's fast tracking retirement, or maybe if you're not even young, a lot of people, they tend to want to make their own schedule. Maybe they want to work fewer months per year or fewer weeks per month or something like that. But the real thing is the main motivation is eventually taking it easy. Now, a lot of the people who find this attractive, they think that's a universal thing, that everybody wants to quit working. But I assure you, that is simply not the case. Some people are fueled by ambition. They want to buy their entire hometown because they want that generational wealth. They want to make sure their great grandchildren never have to hold a day job. And that's why they're going to hustle into their 90s. And even though in some circles, that sort of mentality is a little bit vilified, you got to remember that somebody has to stick around and make sure that things are getting done even when everybody else is willing to throw in the towel. And these guys, quite frankly, are real assets to their GP teams just because they're just going to keep going. So
Yeah.
that's the fourth one. The last one, though, they're similar in the sense that they're going to keep hustling into their 90s as well. But instead of being for their own name or something like that, they've picked a sector of society, or maybe it's the environment, maybe it's animals, who knows what it is. But they found out in order to have a really big impact and make the difference that they want to make, there's a financial component to that that's pretty big. And they use commercial real estate as either a store of value or an equity multiplier, basically a vehicle that way. And that's why they're doing their acquisitions. So, Amit, I saw you light up on one of them, but what combination of these five motivations would you say describes you best?
For me, the most important is fast tracking the retirement. That's something which I want. I've been into IT from past 12 years, and I have no intention to continue to do that for next 35 years. So that's one thing. And then have the control over my time. I don't want to trade my time in this 9 to 5 job and then get 2 days in return, like Saturday and Sunday in return. I don't want to do that. I want to have as much as time I want. I have a 6 months old son, so I want to spend a lot of time with him. Don't want to trade my time for working for anyone. These are my two reasons why I started investing in the multifamily.
I love that answer. As a matter of fact, I made a whole separate podcast series called Who Are You Helping? Just to get more people to say that I'm doing exceptional things because I want to spend more time with my kids. I
Yeah.
think the price of a W-2 when you have young kids is too high. You lose way too many opportunities to have fantastic relations. So bravo. I'm really happy that you said it that way. So, but it's really easy to get starry-eyed and optimistic when you're talking about these potential futures. But commercial real estate is a business. All businesses have risks, and commercial real estate is a mature industry. So it's important to keep all of those ideas in check. And if you've ever been involved in a 506B deal, one of these private off-market securities, the SEC, the securities attorney in the mix, and there better have been one. If there wasn't one, you need to run. You have a problem. Okay, anything that offers passive interest. Okay, that if you don't have a securities attorney involved, you are in danger. Anyway, they should have insisted, if it was a 506B deal, that everybody fills out this questionnaire called a suitability questionnaire by some RIAs, registered investment advisors, things like that. And they have lots of invasive financial questions like what's your net worth and stuff like that. And one of the questions on that questionnaire bugged me a little bit because it lacked utility. I found that regardless of the answer somebody uses in their response, it's not going to give me something that I could use and really rely on. So I made my own, and it's a fill in the blanks question. It is. There are many popular investment asset classes, but I think blank is too risky. So, I mean, it can be inside real estate, it can be outside real estate. What's too risky for you to invest in?
Uh, Crypto is too risky for me to invest in. I have lost money there, so I know how risky it could be.
Absolutely, absolutely. At the end of the day, it's an appreciation move. Buy
Yeah.
low, sell high, or lose. And it's you. There are so many better vehicles than that sort of thing. And that brings me to my favorite deal metrics. I'm nerding out here for a second here. And the thing about the favorite deal metrics for the first couple hundred chance encounters, I didn't include this, even though I really wanted to. The reason why I didn't want to include it is because I knew that some people are more like front of house, their PR, their marketing, their the front facing advertiser, basically the spokesperson, and generally they have to be schmoozing with people and hanging out, and they're not going to be up to their eyeballs in the actual spreadsheets and figuring out the different assumptions and risk mitigation basically quantities that they're doing in the underwriting. So I felt that it's kind of unfair to put people on the spot and say, hey, what's your favorite metrics? But even if you are just a financier relations type of person, you're still going to have a few different features of your deals that you're going to highlight. And so that's why I'm asking for your top three or something like that. So that way, if you meet somebody in the audience, they can speak your language. Now, for anybody in the audience who's only listening and not watching, I'll read out this list. It's not exhaustive. It does lean a little bit towards multifamily, but here they are. Cash on cash, IRR, which is internal rate of return. Then there's cost per door. Then there's NOI, or net operating income. There's the going in cap rate, which is actually basically showing the discount that you're getting for that region at that time. Then there's the loan interest rate, which is especially important if there's any seller carry, or if you're assuming a loan. Then there's the occupancy rate, which is the inverse of the vacancy rate. So it's the same thing, just the inverse. Then there's average income, where the property is located. There's the amortization period of the loan. There's the difference between the market versus in-place rents. There's the population growth, where the property is located. There's the sponsor record, which means how many deals have already gone full cycle and how many deals are on the go right now. Then there's the waterfall, split, or exit strategy, which means what happens to your investment after you've had your capital returned. And the last one that I have on here is DSCR, which is debt service coverage ratio, which is how much of the revenue from rent is going out the door immediately just to pay for the loan. Now, of course, that's not an exhaustive list, so if there are numbers that you focus on more, Amit, feel free. But do you want to give a top three or something?
Yeah, absolutely. Occupancy, cash on cash, and going in cap rate would be my top three. The reason being, we specialize in getting stabilized assets which have 90% or more occupancy. So we focus on that a lot. Other than that, cash on cash, something very important to our passive investors. We look for at least 8% cash on cash. So that's why it's so important for us. And finally, the going in cap rate. It's the most important number for us because it determine our exit strategy. If you go wrong in your cap rate, your whole exit strategy can go for a toss. So yeah, these are the three metrics if I have to choose. Although all of them are important, but these three are my top choice.
I love it. I'm eating up that answer like a delicious subscribe sandwich. It looks nice, doesn't it? But
Yeah.
that's my very subtle. I don't even know. It's not reverse psychology. It's my subtle hint to the audience that maybe there's something else to go do, but maybe down there. But the thing I really use it for is to remind me it's time to bring out the Dan Does Deals Commercial Core Competency Cube, which has the 6 different roles in a commercial real estate deal. The idea being, if I go through all 6 sides, then you're going to know how my guest fits into these deals. And you'll also understand there are these 6 different roles. And if you're watching this episode and thinking, wow, I really need to get one of those cubes, the good news is it's free. You go to dandoesdeals.com. There's this great big button. You click on it, sends you straight to the PDF. And yes, you heard me right. I committed the cardinal sin of marketing. I give away my freebie without asking for an email address or other types of contact information. You should never, ever, ever do that. But I want to make sure that you can print this out and try it out and get used to making these distinctions so you can find out who's a this or that, because this person's called an investor, that person's called an investor, that person's called an investor, and it's not very clear. Anyway, let's get started. The first role you need to know about is a repositioner. A repositioner might even be a fund manager to some degree. The main thing about a repositioner and why they're so visible, well, they are the people who need to do a bunch of paperwork and look at a whole whack of different properties to basically be a curator of sorts. Now, of course, the reason why they're called repositioners is because if they're actually on the GP team, part of their job is to figure out how to run the place and not only just stay afloat, how to do better than that property already is. And how are you going to know that unless you actually do a deep dive into the numbers, underwrite the deal, figure out the assumptions, and find out if the property is even making the amount of money that the broker or seller claims it is? Because anyway, so the most peculiar part about being a repositioner, though, has to be the fact that they have to have a wide network of financiers. What's that all about? So financiers are not on a GP team. The GP team members, a financier could also be a fund manager. That's completely okay as well. But financiers are people who deal with the owners, paperwork, and capital, and that's it. So they don't have any responsibilities as far as tenants or residents or whatever you want to call them. But the reason why the repositioners need a vast network of financiers is because if you can access a cheaper loan, then that goes straight to the profitability of the building. So it's all ultimately arbitrage, and the financiers, that's their role, and that's why the repositioners are bugging them all the time. But the business side of what the repositioners do, they're first going to look at the operations and stop those Benjamins from going down the toilets. Now, of course, if you're looking at bigger properties, the fact is you might even be outsourcing your operations. So asset management is absolutely part of operations. But one of the things that I contribute to GP teams when I'm involved in a deal, and of course I'm going to be remote based, because I don't know if you know this about me, but I'm from the internet. Okay, so I'm far away, and the way that I can contribute to the actual deal and how it's run is, of course, the web-based assets from my history in the CRM agency and full stack development. But the bigger one is understanding that vacancy is the enemy in commercial real estate. So even if you are outsourcing the property management to a third party, you better have somebody in the fold who has some really serious marketing chops to get those units filled, because that's going to kill your deal more than anything else. Another thing that can kill your deal, it takes a little bit of skill, and it's the next spot where the repositioners are going to be looking for upside. It's by getting a contractor team involved to upgrade the property, do a value add, do the renovations, and then that way the future residents would be happy to pay more in rent than the previous ones. But if only it were that simple. You could go ahead and foot the bill to gold plate the toilets, but I really don't think you're going to get a return on investment. But that's not the only way that you can waste a bunch of money. You can also waste a bunch of money by them taking too long, dragging their heels, or using subpar materials. And if you're like me and you're from the internet, the fix for that one is you need boots on the ground. You need a local, somebody who lives an hour or two away, because I promise you that an hour or two, I'd still be stuck at the airport. Okay, there's no way I'm going to be able to get to these properties in that short of a time. And so somebody has to be able to do that to make sure that the contractors are staying on schedule, making sure that the operations teams are doing their job, just basically be nearby. So now for the next part, though, I'm going to start off with a hypothetical. You know, Amit, you're in technology and all that kind of stuff. Yeah, you might be in technology as well. Or you might be an engineer or an attorney or a physician, and you thought to yourself, well, I know how to buy a rental. I have a down payment, and I just borrow the rest. I bet if my friends and I pool $100K each or something like that, we could buy that 350 unit apartment complex down the road. And so all filled with confidence and a contract in hand, you turn around to the financiers, the banks, you say, hey, I want to buy that building over there. It's tens of millions of dollars. Yeah, you don't have, I don't know, say tens of millions of dollars you want to say, lend us, do you? Well, the flaw in your little hypothetical here is that the financiers are going to want to know who's the KP, who's the sponsor. What's that all about? At the end of the day, lenders are giving depositor money or investor money to these different people, these different borrowers. And so they have a duty to make sure that you're not going to take all of that money and run the place into the ground. So one of the ways that they do that is by insisting that somebody in the fold already owns a similar asset. In other words, there's going to be no 350 unit apartment complexes in your future with a loan unless somebody in the fold also has a 350 unit apartment complex already. Now, of course, on top of that, you need a certain amount of liquidity to prove that you can actually run the business. You're also going to need to put up collateral. In other words, have a balance sheet among the ownership team of at least the amount of the loan. But if you have all those pieces, you got yourself a commercial real estate deal. So, Amit, I'm sure that you have some repositioner responsibilities. I imagine asset management. You might have a fund. And of course, everybody is in charge of deploying capital. So you have some investor relations. But which sides of the puzzle are you going to take over mostly?
I focus mostly on the operation sides. That's something, the asset management, it's the most critical piece of the puzzle when it comes to a multifamily deal. It's easy to acquire a deal, but the hardest part is doing the asset management, making sure of those people who are living on those apartments. Are they happy? Do they have complaints? So that's the hardest part, and that's the area where I spend most of my energy in, and I absolutely love it. I love solving the tenants' problem. I love getting good feedback whenever they validate my effort. It feels so nice, and it also feels nice to provide them a safe and secure environment where they can live and raise their family.
I love that answer. I love that answer. So let's talk about the buy box then. And when real estate people are saying, hey, what you looking for? What's your buy box? What's your ideal property? We're really asking for three things. First one's going to be geography. Where is it? Which states? Which county? Possibly even which neighborhood? It's all going to matter. Now, the second one is size. Now, most of my guests on this show are in multifamily, and the way that you dictate size in multifamily is by the number of apartment units or unit count. Now, the reason why it's relevant to know this, though, is because the type of group that's going to take over 10 and 15 unit apartment complexes, they're going to be fundamentally different from the type that take over 100, 150, 350 unit apartment complexes. So that size is going to matter. Now, of course, other forms of commercial real estate are out there where go by either acreage or square footage, the number of pads, things like that. But the rule of size is still going to apply. But the third one is commonly called class. I'm not a fan of that term. I think it should be desirability just because it's more than one thing. When they're talking about class, they're talking about the condition and then they're talking about the area. If you're talking about condition, it's what's the state of the property? Is it a really old building or is it a new build or where in between? Has it been recently renovated? And then as far as amenities go, is it a place that's very exciting to live at or is it just basically supposed to be a place to hang your hat, so, as they used to say like 100 years ago? But that's the condition. When you're talking about the area, we're talking about residential fundamentally. So that means the school districts are going to be very relevant to multifamily and other residential, whereas the universal parts of the area that are going to impact its class or its rating, it's going to be the crime rate where the property is located, and then the bigger one is the old broker trope of location, location, location. But what they really mean is traffic, traffic, traffic. In other words, more people pass by that property every single day, it's going to be worth more than one that's crickets. And then both the area and the condition are ranked the same way as in grade school. So you have A plus at the top, and then A minus, and then B plus, and then B, and so on. So, I mean, as far as you and your group goes, you already mentioned that you do the stabilized properties, which is exciting. But what's your buy box?
Yeah, we focus on Phoenix market and anywhere between 40 to 100 units. That's
Mhm.
our buying box. In terms of the class, we look for B, C plus and B minus properties in B and C areas. Mostly avoid C areas, but B and A and B areas. So yeah, that's in a nutshell our buying box.
Excellent, excellent. My our founder at our new debt fund, he's in Gilbert, and I know that we've sometimes been looking at Tucson. Would you be willing to look at Tucson as well, or does it have to be Phoenix?
No, Tucson is a great market. We are open to go that far. Currently, we're just focusing mostly on Phoenix and some markets, but Tucson, yeah, it's great, and we can always look for deals in that market too.
Okay, beautiful, beautiful. So that's great. So let's talk about people. Now, of course, everybody in this industry is in the business of deploying capital. So having those relationships with financiers, it's going to be really, really key. But everybody is so friendly inside commercial real estate, and I chalk it up to the fact that it's multifaceted. You've got these different roles. Nobody's going to be all six sides for any meaningful amount of time. And so that means we're really frequently eager to give referrals, introductions, things like that, people to create more of these teams. But at the same time, we have our own unique skill sets, which means we're going to be better off helping some people than others. In other words, the recipients of our help will benefit more than somebody who's not in that position. Me personally, because of my digital background and the marketing and my time in real estate already, the sponsors and KPs tend to be the people who I'm most eager to speak to, especially now that I'm involved with a debt fund. So the sponsors and KPs I'm eager to speak to, but of course in the capacity of these interviews, I need to talk to absolutely everybody, and happy to talk. But I mean, as far as you're concerned, if you have any 506B deals, don't go saying that you're looking for investors and say the name of the deal, because that's the thing you really, really can't do. But who are you best suited to help?
I specialize in underwriting, and if you have a deal and you need other eyes to look at it, I am there. You can reach out to me, and I can help you, give you another opinion about your underwriting, and give my opinion. So yeah, that's something which I can help with. And as I mentioned in the beginning, asset management is another area where I specialize in. And if you have any questions about asset management or facing any issue and don't know how to resolve,
Mhm.
you can reach out.
Excellent, excellent. I love it, and that brings us to the question of how to reach out. And I'm going to monopolize it for a second. So I have a pretty distinct looking last name, as you can see right here in the corner, and that makes me super easy to find on LinkedIn, which is the social media platform where I spend most of my time. But if you check out my name on Amazon, you'll see that I have a few different books out on topics related to business skill building. But if you are thinking about raising capital, if you're thinking about offering passive interest in a startup or something like that, you need to know that there are securities laws related to that. I encourage you to pause the video and scan this QR code because that'll take you to the FAQs page of 506 BME, which is the platform where I offer the service of backing up that your documentation of your substantive relations, so that even if you I don't know, drop your laptop in the bathtub, you're still okay when the SEC wants to see that documentation. So that's what 506 BME does. But Amit, if people want to reach out to you, social media or website or phone, email, what's the best way to reach out?
Bigbrickcapital.com is my website. You can just go there and you will see my contact number, my social media profile, and even a Calendly link where you can share, where you can schedule a meeting with me. So bigbrickcapital.com.
Okay, okay, big brick. Excuse me, that's something in my throat. Big brick is what you said, right? Big brick capital.
Yeah.
Excellent, excellent. And that brings me to the last part, which is actually the public service announcement. So it's not for you, Amit, it's for you in the audience. If you've been watching this episode and experiencing searing pains in your eyeballs and like migraine like symptoms, I'm confident it's because of that subscribe button. It's hideous. It's embarrassing. People will see that you're not subscribed and they'll be like, I thought I knew you. But it's free. You just hit it. It's free. Okay. I want a lot of people to hit the button because then YouTube will start to pay for these videos instead of me. And I think that would be amazing. And the trade-off to you, if you're unaware, if you've been living under a rock for the last almost 20 years, what it means is my videos may show up on your list of suggestions. But you can ignore those suggestions. I just appreciate the fact that you spent this time with me. Just like, I mean, this was a real pleasure. I really enjoyed this. Thanks for joining.
Yeah, it was a wonderful pleasure for me too. Thanks, Dan, for inviting me. And guys, please hit subscribe button.
Right?
Is doing amazingly well, and he provides a ton of free information every week, every day. So yeah, just go and hit that button.
Awesome. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506 BME or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.
And maybe it's, oh, why did I see that?
Cool. Okay, I know what I'm going to do.
I know what you're gonna do too. And
As you're talking, I'm like trying to. This is a perfect, perfect little game. I love it.
no, not that one.
I was actually like, uh-oh. I'm like, oh, no, okay.
And then you thought for a second, Emma, bad move, bad move.
I
Right.
see what you're doing, but I can't stop it.
You've absolutely pinned that one down.
Oh, yeah.
When did you take my queen? This is very distracting.
Yeah. Well,
Oh man. Yeah, I don't like you so much, Dan. I'm just saying.
finally.
I really. Let's be honest here. You'll probably never speak to me again. I'm just not coming back. I don't know.